My name is David Goldman, and it's my pleasure to introduce the Stephen L. Wright Wealth Management Method. We're going to be talking about very high returns over 10 years, averaging 35% per year. Only one down year, minus 4.5%, that was 2005. And in 2008, when everything went down, Stephen made a phenomenal 57%. Last year was 47%. These are before fees. But more to the point, I'm going to show you a unique method where we will use YouTube to prove 100% our past performance, and you will be able to track our current performance in an open, transparent way. We're going to talk about a very different methodology of investing, but first let's look at the traditional methodology in terms of mutual funds. On any given year, how many mutual funds beat the S&P 500? It's a phenomenal only 25%. 75% of mutual funds do not beat the S&P 500 index. Those that do repeat rarely repeat next year. In fact, since 1970, only 13% of mutual funds have beat the S&P. This is really proof that fundamental analysis, or if you will, economic analysis, balance sheets, markets, global economy, etc., has really not been possible to predict market performance. These are professionals with teams of analysts, access to resources, and the percentage that fail to beat is really phenomenal when you consider that this is the backbone of our financial industry. There's no question that the current global economy is a challenge. The markets are volatile. The US market, global stocks, real estate, bonds, commodities. We've got unprecedented geopolitical instability, record national debts, almost 0% interest rates in the bank. Investors simply do not know what to do. We are proposing a genuine alternative that is immune to whatever direction the global markets take. Let me repeat that. This is very important from our perspective, that we are not linked or correlated to global markets. In other words, if the stock markets are going up or down in the next few years, it doesn't affect our performance. If the gold market, the crude market, the property, real estate, commodities in general, we are not correlated to the direction of global markets. This makes it a very powerful additional concept for many investors. We believe at least 20% of your portfolio should be in something, not necessarily ours, but something that is not correlated to the economic direction. A quick look at our results since 2001, where Stephen has been trading this methodology. Really phenomenal results, almost at the level of too good to be true. Only one down year in 2005. We're averaging almost 35% per year. These do not include management fees. We operate the standard hedge fund fees of 220, except that we're doing a discount at the moment of 1.515. That means we take 1.5% of the total and 15% of the profits. So those do need to be deducted from these numbers, but still phenomenal numbers that we've delivered. And as mentioned, we're going to show you how, at least in recent years, we can prove that we actually did deliver these. So we've talked that we're different, so let's very quickly get into the methodology of how we trade. If you look at the red line, the straight line, this is indicating that the market in general is moving up. This could be the S&P 500 or crude oil. Just for now, it doesn't matter. The concept is that markets, when they move, never move in a straight line. They always go above the average, then below the average, then above. As investors get greedy and bid prices higher than they should, and then investors get fearful and panic and sell lower than they should. There's been no better example of the Dow Jones since 2008. At 14,000 was too high. Everybody was getting greedy. Then the market crashed down to 6,500. It was way too low. Should not have gone down that far. Now we're back up to, in 2011, over 13,000. So why has the Dow gone from 6,500? Why is it more than doubled in the last couple of years? There's really not been any good economic news. The truth is that 6,500 was too low. 13,000 perhaps is too high at the moment. The point is that these patterns of going above and below what we correctly call the mean or the average is human nature. And this human nature occurs on a year-to-year basis, as we just talked about. It also occurs on a month-to-month, week-to-week, day-to-day, even a minute-to-minute basis. Given that humans are trading, we will always see this pattern, this snaking of the price moving above and below the mean or the average. We trade by buying at the low points and selling at the high points. We have a methodology to detect when these markets are about to turn. We'll talk more later how we do it, but for now, just understand that we trade in and out, and we also trade long and short. Long means that we buy low and we sell high. Short trading means we sell before we buy, hoping it goes down, and then we buy it back later. This is 100% normal in the professional world of trading. This is something often deemed unusual to most investors, but in the world of professional trading, short trading goes on just as much as long trading. So we go in and out, long and short, buying and selling on a 2 to 6 day period, and this is how we deliver our performance. The last slide showed what happens when a market's going up, that the price goes above and below the average or the mean. Well, same thing on the way down. So in this case, we had a market trending up that is now trending down, and on the way down, we have the same pattern of prices going below and above the average, and again, we trade in and out, long and short, to take profits out of the market, irrespective of the direction. This slide is very important. This is the slide that backs up the point we made earlier on, that we do not care which way the general trend is going. So if the stock market in the next 2 or 3 years goes up, that's great. We'll be going in and out on the way up. If for some reason the market goes down in the next few years, we are not affected at all. We will be going in and out, long and short, buying and selling, as the market trends down. We are totally not correlated to the medium or long-term direction of the market. One thing that investors really seek in the world of investing is some form of repeatability and consistency. We believe the mutual fund managers, even the ones that beat the market, rarely repeat. In other words, the mutual funds have proven that you cannot pick stocks. You cannot pick a subset of stocks based on economic or fundamental analysis. With our methodology, we are using human nature, and human nature has never changed, whether it's the year 1900 or the year 2011. This gives us a repeatable strategy. We have a formula-based methodology that doesn't change. We execute the formula. We don't have opinions. We execute the formula that has been built over 30 years of. Most retail investors will have an opinion that commodity trading is risky. Risky is not the right word. Volatile is the right word, meaning they can go up a lot in one direction or down a lot in the other direction quickly. The way we trade is we let the winners ride. If it's going up, we let it go. However, if it's going against us, we cut our losses quickly and automatically on every losing trade. Historically, we've won 66% of trades. We lose 33%. Of those we lose, we have a predetermined exit of approximately 2% of the portfolio, maximum loss per trade. In simple terms, if you have a $100,000 portfolio, we will generally not lose much more than $2,000 on any given trade. So if we think crude oil is going up and it goes down, the software will take us out of the trade automatically. Could be the middle of the night, we could be asleep. The systems are all programmed with one of the biggest brokers in New York, and we will exit the trade. So we don't lose money by being wrong on a particular trade, or we don't lose much money. The way we lose money is being wrong multiple times. So for instance, if we had 6 or 7 losing trades in a row, then yes, we could lose 7 times $2,000 in my example. But we don't lose by being wrong on one particular trade. So from this methodology, volatility is good. We actually want to be trading instruments that are going to go up a lot when we get it right. And if we get it wrong, we exit out of the trade very quickly.
This is the end of part 1. Please go to part 2 for the remainder of the presentation.